As we head into the final quarter of 2025, the global economy is sending mixed signals. On the one hand, growth has surprised to the upside in the United States and other major economies. But on the other, labour markets are cooling, inflation remains stubborn, and tariffs are reshaping trade flows. Investors are asking, are markets rallying on solid ground or are they priced for perfection? Every quarter, Investec's Global Investment Strategy Group, a team of senior strategists from the United Kingdom, South Africa and Switzerland, meets to map out the global outlook over the next 18 months. Their collective thinking is published in the Global Investment View, which distills the risks, opportunities and potential icebergs that are facing investors. Joining me today to discuss the latest Global Investment View is Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment International, and a key member of that Global Investment Strategy Group. In this quarter's report, the headline is clear. US markets are trading well above fair value, while opportunities are opening up elsewhere, from Europe and China to South Africa. Chris, a very warm welcome back to No Ordinary Wednesday. So, Chris, let's start with a big picture if we can. The Global Investment Strategy Group keeping its global risk score unchanged at negative 0.5 and South Africa at +1. Can you explain to me what these scores mean and why they have stayed the same?
We start off each quarter having a look at the global picture and deciding how much risk we should be taking across our business. And the risk score ranges from -3 to +3. -3 is roughly equivalent to about 15% underweight in equities. I say roughly because we could express that in other ways, for example, an underweight in credit. And +3 equates to about a 15% overweight in equities. Now, at the moment, we're at -0.5 globally. And the reason we're unchanged is since last quarter, we've seen two primary changes across the globe. The first is that we've had very strong performance in equities. And normally in that environment, we'd start to get a bit more cautious and reduce the risk score. But offsetting that, we've seen a shift in narrative from the Fed. They're much more willing to cut. We've now actually seen a cut and we expect there'll be more cuts to come. So those two offset each other and we've kept our risk score at -0.5, meaning that we are mildly defensively positioned. In South Africa, in contrast, our score is at +1. We see opportunity for deploying risk assets in SA. And also we've kept our risk score unchanged there. And the two primary drivers have been, again, strong performance in the local market. But in addition to that, we're starting to see some green shoots and some of the SOEs and commodity prices have been strong. And you put all that together and we still see opportunity in the local market.
Chris, let's return to America. You've described the US equity market as, and I quote, priced for perfection, about 40% above fair value. Now, given strong earnings growth and also the Fed shift towards cutting rates, what's keeping valuations so elevated? And I guess we'd want to know how sustainable this is.
I think there's a few considerations at play. The first is earnings growth. Over the past several quarters, we've seen very strong earnings growth out of the US with a wide array of companies beating on the bottom line. Earnings is consistently surprised by a sizable amount. And with that, we've seen some pretty impressive margins that are consistently high and much better than had been expected too. And in addition to all of that, we're still seeing some pretty sizable buybacks in the US, well above the sort of levels that we've seen a few years ago. And all of that is keeping the market elevated. As your question is, how persistent can that be? I think at the first signs of weaker earnings growth or lower margins, we're likely to see some of the air taken out of the market. And from a valuation perspective, there's very little margin of safety. And historically, we know that it's times like this that one needs to be cautious and opportunistic. And I think we probably don't have too long to go before we're going to get some less than stellar returns out of global markets, particularly the US.
Well, Chris, talking about air out of the market, at the same time, the US labour market is cooling, payrolls are weaker, bankruptcies are rising, yet AI-driven investment is providing a new growth engine. Interesting to reconcile perhaps those two contrasting signals.
Yeah, I think this is going to be the key talking point for the Fed. They're looking at a very difficult situation at the moment. You've got GDP growth, which appears to be very strong. In Q2, you're looking at growth close to 4%. In Q3, at the moment, it's running close to 4%, while the employment market is showing clear signs of slowing down. And so for the Fed, they've got to reconcile these two views. And if they go with the GDP numbers, then there's limited reason to cut at all. And if they look at the employment numbers, then there's lots of reason to cut. And the problem that they face is that at least one of those series is going to be revised. And if they act on the data which is subsequently revised, they open themselves up to criticism and potentially a loss of credibility. So it is going to be the key talking point as to how these different data points are reconciled. I think as things stand, the market expectation of them cutting by 4 times over the coming year is quite optimistic, given the growth numbers that we're looking at. And I think, if anything, the way that it's going to settle is that they're going to cut by less than the market expects.
And compounding the problem are inflation risks.
Absolutely. Inflation at the moment is sitting at 3%, there and thereabouts in the US, and there's absolutely no sign of it slowing anytime soon. So if you're in the Fed, you've got this environment where inflation is above target, growth is looking good, but the employment situation is looking questionable. I don't think they've got the scope to take a high conviction view on what's happening, and as a result, they probably don't have the scope, again, for an aggressive set of cuts.
Chris, let's move away from the United States. You also see opportunities elsewhere. So tell me why Europe and China look relatively attractive right now, and how important is the expected dollar weakness in supporting those two markets?
Yeah, the dollar is very important in that. We know historically that when the dollar has weakened, rest of world equities have outperformed the US. It's a fairly consistent relationship, and it's fairly regular over time. So as a starting point, if the dollar does continue to weaken, we would expect rest of world equities, European and Chinese, to outperform the US. But in addition to that, we're seeing signs of fiscal expansion in Europe, which should be supportive of growth in Europe. And in addition, we're seeing signs of stimulus being deployed in China. And we're quite constructive on the outlook for Chinese growth over the medium term. That's a non-consensus view. There's a wide set of concerns that have been expressed by the consensus and economists out there around the outlook for Chinese growth. But if we look at key leading indicators for the Chinese economy, they suggest some upside ahead. And most importantly, what we've seen lately in commodity prices, a very strong rally, is suggestive of improving growth in China too. So broadly speaking, we do see opportunities outside of the US.
We're going to continue this conversation shortly with a look at what the global investment view is predicting for South Africa. But I wanted to remind you that if you're enjoying this conversation with Chris, remember he's also got his own show on Investec Focus Radio SA. It's called Macro Monday. Every Monday he gives a quick, sharp take on what's moving markets and what investors should be watching. So if you want to start your week with a clear view of the big picture, make sure you follow the channel and tune in. Okay, Chris, let's get back to the conversation and closer to home. South African risk assets have rallied strongly, but you also argue they remain cheap. What is driving that view?
There's two things at play here. For one, if you look at our market relative to the rest of the globe, our equity market, the South African equities are trading on a forward PE of around about 12 times. If you look at slightly different indices, you're going to get numbers, there'll be slightly different, but it's there and thereabouts, about 12 times, which is at a discount, a small discount to the 15-year median. If you look at the rest of the world, you're looking at a situation where pretty much every other index that we track is trading at a premium. So relative to the rest of the world, our equities are still cheap. And in addition to that, we're starting to see some of the knock-on consequences of higher commodities, which are very helpful for certain aspects of our market. So we've got tailwinds, we think, coming through, and valuation, which doesn't fully recognize that. And the combination sees us remaining quite meaningfully overweight risk assets in South Africa.
And Chris, good to report that Eskom and Transnet are finally showing some progress and commodities are providing a tailwind, as you've referenced. But how much conviction do you have that these factors can sustain any real momentum in South Africa's economy?
Yeah, let's start with commodities. Forecasting commodities is a bit of a mug's game. So we can really just talk about what's happened at the moment, and we can put our best guess for what's going to happen going forward. So they have been very strong, and that's already translated into strong earnings growth for some of the miners, and that is now starting to translate into improved tax revenue for the state, and that will shortly resolve in improving SA Inc. performance as well, in our view. So commodities, they've been strong up until now. Given Chinese stimulus, we expect that they'll be strong going forward, but there's a huge band of uncertainty around that. Switching to SOEs, some of the data locally has been quite encouraging. As an example, last year is the first year in many years that capex exceeded depreciation at Transnet, and we are seeing signs of improvement on the railway lines as well, with the volumes that are picking up. We've seen signs of improvement at the ports as well. And we do think that this has got some legs. There's still a long way to go. So we expect to see continuing improvement in both Transnet and Eskom. And those should then ultimately become less of a binding constraint on growth and allow potential growth in the South African economy to be a bit higher than 1%. So the two factors together, commodities and improvement in SOEs, I think together paint quite an optimistic outlook for growth and suggest that we probably do some upgrades to the South African growth outlook over the near term.
And Chris, you also point out that local bonds have re-rated and are now closer to fair value. So does this mean the easy gains are now behind us?
I think so. If you look at inflation expectations in the bond market, what's currently priced in is for inflation to be about 3 to 4% over the coming few years. You have to ask if that number can go down much. I mean, the SOEs is targeting 3. I think it's unlikely the bond market's going to price inflation being 2 to 3. So it was pricing in 5 to 7, and that's now dropped to 3 to 4. I don't see that part of the bond market is going to improve a lot going forward. A lot of the easy gains there are certainly behind us. In addition, if you look at the spread of our yield curve relative to the US, all the way out to 9 years, our spread is in the bottom quartile of what we've seen over the past 15 years. It was in the upper quartile a few years ago. So there's been this massive compression in yields relative to the rest of the globe. It's been a great market to be in. We've been overweight throughout, but now we're shifting back to neutral. We think a lot of the opportunity is now behind us and our bonds are looking closer to fair value.
And let me widen the canvas again. Across the global outlook, your tally shows more cons than pros. So what are the key icebergs then that investors should be watching most closely over the next 12 to, say, 18 months?
I think the key one is China-DM relations. At the moment, both economies are doing quite well, and that's led to a pretty strong environment for risk assets across the globe, and commodities are doing very well too. But should the relationship between China and the West deteriorate and we land up in an environment where they're not doing as much trade with each other as they did before, or we land up with lower growth in either of those economies, it is going to be a very tough time for risk assets. And that's something we need to monitor very closely. So I would say that's the key iceberg for now. Of course, you don't know what you don't know. There might be something coming out of left field. But of the known risks, I would suggest that's probably top of the list at the moment.
And just finally then, if you had to distill the message of this quarter's global investment view into a line or two, what would it be?
I think globally we need to be opportunistic, where we've looked at markets that have done very well over the past few years. I think we need to now treat those markets with a degree of skepticism and concern, and we probably need to look for opportunities in other parts of the globe that haven't done as well, sort of emerging markets and Europe in particular. When it comes to SA, given the tailwinds we're seeing and the valuation backdrop, there's reason for optimism, and we remain risk-on despite the fact the South African market has done very well, in fact outperforming the US market over the past year and past 5 years.
Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment International. Chris, thank you very much indeed. That's where we're going to leave it. Thank you so much for joining us. And as always, a very enlightening discussion with you. And if you enjoyed this episode, please follow Investec Focus Radio SA wherever you get your podcasts. We will be back in a fortnight with more analysis on the major economic trends shaping our markets. Until then, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.